What's up, team? Sean from Vesta Live, and I want to talk to you about two really important things. Number one, I want to really cover a little bit on my thoughts on Palantir and their buybacks. Number two, I think a lot of people don't really understand what a buyback means. I saw some questions that made me a little bit nervous during some live streams, during some Twitter feeds, where people seem to be misunderstanding, asking questions like, will they take my shares? What does this mean for the company? So what I want to do is give you a real nice 101 level education on what buybacks are. And I want to share my opinion and thoughts on what this means for Palantir, why I think a lot of folks were surprised by the timing, and why I think it actually makes a lot of sense if you understand sort of the thought process behind it. So what I'm going to do is I'm going to share my screen. We're going to jump right in as usual, not waste any of your time. And without further ado, let's rock and roll. Excuse me. So first things first, let's get my screen share up here. Team, buybacks are part of the realm of investing, okay? And what I want to share is we have to learn to really not get emotional about these announcements. It's just part and parcel for the course. You're going to hear it in a lot of companies, especially in volatile markets, for companies that are sitting on a lot of cash, which, to be frank, a lot of companies are right now. So look, simply put, a stock buyback, also known as a share repurchase, and you'll often hear the board has approved a share repurchase program of X amount of dollars, is when a company buys back its own shares from the open market, okay? And they do this using surplus cash, or sometimes they'll even take on debt if they have good rates. The reason a company will do this is that there are short and long-term benefits to the stock, the company financials, and hopefully oftentimes the shareholders. So really, let's get into some basic details here. And this won't be a long video, but I think it's important you understand, why do companies buy back stock? Well, number one, it's to increase EPS or earnings per share, right? So if you really think about this in simple terms, reducing the number of outstanding shares increases the earnings per share. If there's less shares to be divided into earnings, right? Earnings are going to look better when you report it. So it looks more attractive to investors, especially for a company like Palantir in this case, who's trying to get S&P inclusion, trying to get more institutional investing. And it also helps the shareholders to buoy the price up, to make earnings per share look better. Because remember, in the case of a Palantir, and this isn't just for Palantir, but in that case, they have a lot of outstanding shares, and this can be a problem. It's also to return capital to shareholders. It's an alternative way to return capital to shareholders as opposed to paying dividends. I want you to take a step back and understand why this is so important to look at this the right way with the right framework, because I think the vast majority of people don't really understand the way markets or stocks work. They just think they do because they've learned a little bit about it from investing, in a short period of time. When you receive a dividend, whether it's cash or reinvested, you are paying taxes on that dividend. It's a realized event. You received a payment. When a company repurchases shares, the value is integrated into the stock price. So you holding those shares, hoping that the value will go up, is an unrealized event, right? So you're not paying taxes on it. So it can, for many people, be a better way to go about increasing the value of their holdings. There's also compensation programs, right? Some companies might buy back shares to award stock to employees as part of their compensation. Now, I want you to understand, this is not going to be something you hear about a lot, but oftentimes when a company is formed, right, a C Corp is formed, they will petition a certain amount of their shares for employee stock programs. In theory, if that program gets too small or they've given away too much of the shares, they could then in turn repurchase shares to put back into that program. It's important to know this. It doesn't come up or happen really often at all, but it's still good to know why. And then another big one is to offset dilution. This is particularly important for shareholders to make sure that along with that EPS and return of capital, dilution is being, watched with a tight eye, right? So companies can use buybacks to offset the dilution, the results from issuing stock options. The idea being that as more options are going out to employees and executives, they're also pulling in more from the public market to kind of keep a fair balance so that you as an individual shareholder are not diluted, okay? Very important to understand this. I want to talk about two more things, near-term effect and long-term effect. I think it's also a real easy way to look at this and get excited in the near term and misunderstand the broader picture here. So there's really three key things for the near-term effect, right? We oftentimes, not always, but oftentimes we'll see near-term share price increases. So when a company announces a buyback, it can lead to an immediate increase in the stock price, as many investors will often interpret this as a sign of confidence by the company to bring in its own stock. It believes there's a lot of value there and that the price is lower than it should be based on the direction or trend of the stock price and where the company's going in terms of revenue growth, etc. Liquidity, right? A buyback can provide liquidity in the market for the shares. Also, very important to understand that for some companies, if trading volume is low and you have many investors who want to start seeing some action here, this does create sort of an organic liquidity event. And oftentimes when repurchases or buybacks happen, it isn't like they take $1 billion and throw it in the next day. It's often planned over a long period of time. There are sometimes things built into the program for when and how and what if, right? So keep that in mind too. And then really the one that I'm personally the most excited about when I hear about buybacks, and we cover this with the EPS piece, but it really is important to understand, is that it's about the improvement of the ratios we're all tracking as investors, right? So earnings per share can get a boost due to the reduced number of shares outstanding. We already covered this, but I'm going to say it again. When we talk about earnings per share, if you have a ton of shares, earnings per share doesn't really look good. Even if EPS is good, the average person may not know how many shares are outstanding, so it can be a little bit intuitive to know how to go and look for that information. Now, long-term effects, okay? 3 big things here. Number 1 is capital allocation. Companies will frequently do buybacks if it's of its stock instead of investing in new projects or technology. It could, but the concern here is it could potentially hamper long-term growth. I want to say that again. A lot of times what they're saying is we think it's a better opportunity to buy shares than to do acquisitions, do R&D, do whatever with that capital. It's up to you for how you feel about that, but that's often what's going to happen. Now, conversely, those projects might not offer a good return on investment, then the buyback makes more sense, right? In the case of Palantir, we see a lot of stuff happen with those SPACs, not really good stuff. Maybe this is seen as a way to get some of that capital back in the hands of shareholders. It's up to you to interpret it the way you want to. There's also a balance sheet impact as well. So for some companies, if they're not sitting on cash, if they took on debt to finance the buyback, it could increase its overall leverage, which again is a risk. It might make it more vulnerable if we see things crash again. Now, you might be saying to yourself, well, wait a minute, these all sound really terrible for a growth company. Yeah, team, it kind of is. And the other piece as well, depending on the type of company or what economic indicators we're viewing, the dividend piece can be important too, right? Some companies will reduce dividend payments in lieu of doing this. So with fewer shares outstanding, the company might actually save on dividend payments if it does in fact pay. In a really easy example, the way I would think about it is like this. If you have 100 shares of a company and they pay $1 per share and they buy 20% back, instead of paying $100, you're paying $80 in outstanding shares. So sometimes that can help to sort of go back into the numbers a little bit. Again, these aren't the ones that are very often, but I want to call it out. I've kind of alluded to this over the past couple of screens, but I wanted to really put this on the screen for you to understand, like, why do buybacks typically get a lot of pushback from the general population, the media, the people who maybe don't own this particular stock? So there's 4 major pieces of this. I can certainly talk to them in regards to how Palantir would view this, but I'll get sort of through this first. First off, there is oftentimes, and I think we saw this with this recent announcement from Palantir, perceived misallocation of capital. Oftentimes, critics will argue that some companies use buybacks to artificially boost their EPS. We already talked about that, and prop up stock prices rather than investing in more sustainable long-term growth opportunities. I think this is a fair, regular concern for a lot of investors. It's one that I frankly feel the same on. I do not ever like the idea of propping up or helping EPS. I'd rather see better revenue growth, better investing, more marketing, hiring more salespeople, whatever the case is. There's also income inequality. We live in a world where everything is going to be on the media, and it's going to be all the way to the left, all the way to the right, somewhere in between. So it's also important to understand from a company perspective that this idea of income inequality can be looked at in a lot of different lights. So the reason this is important to understand is that buybacks often benefit the top executives and largest shareholders more than anyone. So the typical rank and file employees or regular investors get very little actual benefit from this than the actual people making the decisions to do it. So it doesn't necessarily help their job. It doesn't help them make more money, but the people who have all the sort of ownership already have even more power in that ownership. There's also an angle to talk about financial engineering. So many will argue that buybacks are just a form of financial engineering that can mask underlying problems within a company. Could not agree more. This is almost always going to be talked about after any buyback is announced. So just keep that in mind, that we can talk about everyone does it, or it's pretty commonplace, or it's just what happens in the industry. All true. But maybe you have to ask yourself, like, but is it the right thing? Hard to say. And then finally, the biggest one for me oftentimes, and this doesn't affect all companies, but are there debt concerns, right? Many companies will actually borrow money to do buybacks, right? So if a company incurs significant debt to finance a buyback, it could end up being a really risky move, especially if the company encounters financial hardships later. And, I think we're coming out of a tough time at the making of this video, but that's not to say that we're clean and clear at this point. So let me summarize this and take just a minute to talk through what I think the deal with Palantir is here. So look, stock buybacks are a tool that companies use for various strategic reasons, as discussed, right? They can have a positive and a negative implication depending on how they're implemented in the specific context of the company. Okay, got it. We know what buybacks are. We know the different parts of a buyback. We know the near term, the long term, the overall thought process here. So Palantir announced $1 billion buyback of its stock on their earnings call this past day. And I think that there was a range of emotional responses to this. And I think it was everywhere from why now? Why do this? Why does this make sense? This is great. This is terrible. Let's just take it sort of piece by piece quickly here. And I don't want to belabor this video into eternity. A lot of questions were on why now? And team, you have to understand these decisions don't get made in a bubble. They can't be made randomly just because the stock price goes down. I think a lot of newer investors who haven't seen the back end of the way financial systems work, or they don't understand the operations of a board, you can't just wake up in the morning and be like, yo, Carpy, it's time to buy back shares. Done. There needs to be a board meeting, there needs to be an assessment, there needs to be an understanding, because it needs to be defensible. If they get sued for doing this, they need to explain the why, the when, the what for doing this, because a lot of shareholders might not be happy, right? So one of the things that I think became very obvious after this announcement for Palantir specifically was like, why the heck wouldn't they do this when the price was at, these really low numbers? And why do it now when the price has already gone up? I think there's two schools of thought here. I've shared across a few different platforms myself that it's sort of like buying a house when it's on fire. Like, wait for the fire to be put out, see where things are. And look, if the house looks like it's savable, expandable, you're going to make a lot of money on it, sure, then let's get back in and buy. If you think that the stock is going to go up even more than it is today, then you shouldn't be concerned if it's being bought back right now. If your concern is that they're doing buybacks at a value that is over the value of the company, that's why you would be upset. I'm not saying buybacks are good, bad, or should be done for this company. I'm just saying you have to understand the way things happen. It doesn't happen over a 30-second period. It doesn't happen over a quick phone call. There has to be multiple meetings to understand the true impact, thoughtfulness of this, and have teams of attorneys write these things up, okay? So a little bit of patience and maturity is really important in understanding how decisions are made and brought to the public markets. Now, all that being said, I want to give my actual opinion here. I am a bit perplexed on why a company that is or should be in like hyper growth mode with tons of open positions to hire and not the best growth based on this most recent earnings would do a repurchase. Now, logically, I can explain it as they have a ton of shares, which hurts EPS. That makes sense. Logically, again, I can explain they want to thank their investors for sticking with them. I can understand that. Logically, I can understand they've done a lot of SBCs and dilution's been something that's come up. That makes sense to me. But I don't invest based on financial engineering. I don't invest based on finagling EPS. I am looking at companies, not stocks, okay? This is the fundamental thing of this channel, of the way I invest. I'm looking at the trajectory of the company and how to accelerate growth. I want rocket fuel. What I don't want is nickels and dimes to fall out when they're taking off. So for me, this was not a surprise move. I don't think anyone was surprised. There was some degree that of guess that this could have happened. I just am more concerned about why there's nothing better to do with the money. I don't care about the price at the purchase of the repurchase agreement. I don't care whether it was high, low, medium, what the growth potential is of the stock. Just the company. I think about the amount of competition that's out there. They are facing off against major, huge players who, in theory, have a lot more cash than they do in the first place and could now take that cash and play catch up. When I heard that AIP has been released, they've got several hundred clients either using it, about to use it, a few thousand people using it, about to use it. What I hear is an opportunity to go hardcore, pedal to the metal, invest like crazy. Marketing, sales, R&D, expansions, acquisitions, even looking at options for merges. Like, I see a lot of areas that you could have really put hyper focus here. And I'm not sure that this one makes the most sense to me. Now, that said, as you watch the rest of this video, you go back and say, well, here's the reasons why I think it makes sense. Here's the reasons why I don't. You can come up with your own interpretation. But I do think, broadly speaking, with about $3+ billion on the books, is this the absolute best they could have done with that money? I don't think so. Do I think it also hurts them? No, not really either. So it just becomes a question of, where on the seesaw do we land here? For me, I would have rather seen them hold on to the cash and do something better with it. But at the same time, maybe this is what they need to get that next bump, right? And last point, because I think probably a lot of people don't really think about this. When really big companies buy software, they need to buy from companies that have good reputations, they are visible, they can share resources. There's oftentimes a lot of back and forth. There's a lot of shared marketing. There's a lot of partnering. So if they can get themselves bumped up into S&P inclusion, they can be seen more as a household name. That means more CIOs, CTOs are going to feel more comfortable bringing them in because that's a regular name. And I want to share this with everyone. There was a saying back in the day that CEOs buy from IBM so they don't get fired, because you want to buy from companies that are knowns. There are not a lot of inherent risks. The biggest challenge Palantir, and in fact, any small software company out there has, is the unknown risk of what could happen, what could go wrong, right? These are not always professional leaders. These are oftentimes founders, these are innovative thinkers. There's an inherent risk there for a large Fortune 500 company to buy stuff from these companies. So just keep that in mind too, team. If you're still listening to this point, do me a huge favor, put S&P below. I want to see who made it through the whole video. With that, those are my thoughts. I really genuinely appreciate your thoughts and love when you share them below. Let me know what you think as well. And team, thanks so much. Appreciate you. Have a good one.